Welcome everybody, and thank you for coming to this week's Market Impact webinar. My name is Ann Cadle, and I do the digital marketing for MAR. Just a couple quick reminders before we get started. We are being recorded. Also, if you have questions throughout the webinar, you can raise your virtual hand and I'll unmute you so you can ask. Otherwise, if you use the Q&A function, you can send them in that way. So with that, I will hand it over to David.
I want to thank you guys again for joining this week's COVID-19 market update. I am MAR's Director of Research and Economics, David Arbit. First of all, I want to thank our sponsors, Bell Bank Mortgage, North Star MLS, and RCU Royal Credit Union, as well as Supra. So again, thanks to our corporate sponsors, Bell Bank, North Star, Royal Credit Union, and Supra. And this is, again, an update on Twin Cities residential market activity. We're attempting to measure the impact of COVID on the residential marketplace. Again, the only thing that really matters here is that you and your loved ones are safe and healthy. So on behalf of our association, our board, and the whole family here, we want to wish you guys that everyone's safe and healthy out there. We also have a resource page that we want to share with you. I know many of you know about this, but there's also some new folks on the webinar today. So if you guys go to mplsrealtor.com, right there on our homepage, you'll be able to see a whole bunch of resources that are going to help you. And I think I even have a little bit of a taste of what we offer there. So MAR in your corner, we've got some of our business operation info, business practices, the local market updates that I'm very fond of. Our EPD team is getting some CE off the ground. Eric, our government affairs director, is doing a great job sort of capturing the government response at the local, state, and federal level, and a lot of other things. Here's our MAR weekly webinars. You are here. This is where we are now. So just before we kick off, data is knowledge, and knowledge is power. And therefore, I think it is by the transitive property, data equals power. So we know we're living in this era of big data. We know that data matters a lot in the real estate space, especially in times like these. You know, you ask 100 agents and you'll probably hear 100 different market realities. So some say we're living in a post-fact era. Those are not my words, those are someone else's. So I think it's pretty important to push back and provide real data, real hard facts, and just kind of ground ourselves in those facts. So a little bit of a different approach this time. Instead of focusing on the economy and the recovery, I think we've done an all right job at covering that. We're going to kind of focus on the market today, and then we're going to talk some InfoSpark. So I'll do a little bit of a demo for you guys, and I'm also going to show you some April numbers, and we're going to use InfoSparks to kind of do a little bit of an update, especially for April. On the market side, we're going to talk showings, obviously buyer and seller activity. I've kept some of the March numbers in here, and then we're going to kind of compare those to the April numbers. You guys are going to see we break down a lot of activity by price range, because what's happening with $250,000 homes is not necessarily what's happening with $800,000 or $1 million homes. So we're going to kind of break that down for you guys and kind of take a nuanced approach. So as we've said before, everything still depends on three things: the length of the pandemic, the impact of unprecedented levels of stimulus, and then the consumer response or reaction and how that drives consumer spending and consumer behavior. So I got a little bit of a visual down here. I have to credit my friend Allie Wolf. There's coronavirus on the left side, sort of tugging at this tug-of-war game. And there's our government response first. Looks like we have Jerome Powell of the Fed, so the Federal Reserve has taken, again, unprecedented actions. And then we've got our public health experts and our scientific community kind of working hard to get to a vaccine and speed through some of these trials if we can, so we can get some herd immunity going and continue to flatten the curve. So it's kind of how I think about a little bit of a tug of war that's going on. You know, things move and change fast. Not to take too light of approach, but if I had told you back in December or even January that a small bottle of Purell or Clorox or Lysol would be worth more than a barrel of oil, you probably would have told me I'm crazy. But here we are. All right, let's keep the mood light for just another moment. 2020, written by Stephen King, directed by Quentin Tarantino. And let's leave the Voyager and travel into 2020, and then maybe not. Nope, that's kind of a bad idea. Marty, I just came back from 2040, and people still have unused teepee from 2020. I got a kick out of that one. Flux capacitor is still fluxing. So let's get into the market. Here's our showings trend. Every week we update this in our Monday blog, and I actually update it even further for you guys for our Thursday webinar here. A little bit of an incentive to come back. So we can see we've had a pretty good recovery on the showing side. Consumers seem or appear a little bit more confident, a little bit more willing to get into some of these listings, take a look whether they're virtual or in person. You can really see we're actually pretty close to where we were. Not quite back, but we are pretty close. You know, another way I kind of think about this, and I know I showed some of this last time, you know, this seems to be sort of this early rebound period where we kind of snapped back. And then we've kind of gotten into what you might think of as a little bit more of a natural or sustainable or, you know, historical growth rate. And note that there's pretty good alignment with the slopes of these curves. Not to get too granular and too nerdy on you guys, but I thought it was pretty interesting to see that early, pretty quick recovery followed by a more natural growth rate. So we've seen this acceleration in showings. Have some of these health concerns passed? I know some folks are ready to get out there and get back to normal, whatever that looks like, and others are less eager. Are rates too good to pass up? The 30-year is still around 3.4, 3.5, maybe 3.6, depending. Are we taking advantage of less traffic out there and less competition, especially in the affordable price point, say 150 to 250 or 2 to 3 or so, or even 2 to 3.5? Are folks taking advantage of the fact that more of these people who would be at showings or writing offers are kind of hunkered down, staying home? Are these stimulus and relief checks really doing the trick and are really inspiring and motivating consumers to get back out there? Are we just getting stir crazy and need something to do? Maybe people suddenly need more or different space, like a home with 4 home offices. That's an interesting one. Is this all an overreaction, right? Just a note, it wasn't worse because we stayed at home. So let's try to keep that up to the extent possible. The economy will recover eventually. Those who tragically lose their lives will not. So I think that's just kind of a good perspective to keep in mind. We have been sort of segmenting or subdividing the market into these 3 categories: affordable, luxury, and what you might think of as the middle market, mid-market ranges, maybe 3 to 5 or 3.5 up to 5.5 or so. And so we'll keep talking about that. But just think about how these different buyers, these different groups, these different market segments are affected differently depending on the job loss, what's happening with stocks, the perceived wealth effect, layoffs or furloughs in certain sectors of the economy where a lot of first-time buyers are employed. So you just think of the leisure or hospitality and restaurant and retail space where a lot of younger buyers, maybe millennials, a lot of first-time buyers, unfortunately have lost their jobs and can't work from home. So those individuals may not be as likely to buy, at least in the short term. And I made a little note here. We still have such strong demand and such weak supply in that 2 to 3 or 2 to 3.5 range that I kind of expect prices to remain pretty firm there. I can't necessarily say the same of luxury. So in the luxury segment, I want to talk about this wealth effect where luxury buyers are a little bit more affected by stock market swings or gyrations in capital markets. And so there's this perceived wealth effect that obviously can affect confidence, spending, and other dynamics. And then there's the middle market, just kind of regular salaried professionals who can work from home, maybe growing families and some new household formations. An interesting thought that I know I brought last time, just kind of an interesting thing to think about downsizing boomer households, or what will this whole virus thing do to 55 plus or 65 plus senior living type arrangements. So again, just a quick note here, look at where a lot of the job losses were in March. This is from the non-farm payroll report. BLS, the Bureau of Labor Statistics, does a really good job of bringing this stuff to us. So we can see pretty clearly that leisure and hospitality was the sector that experienced the worst job losses. So again, a lot of first-time buyers, not all by any stretch, but a lot are employed in some of these sectors that were fairly hard hit. I think I've got one more quick example that shows, look at where a lot of the job losses were sort of broken down by education. It was actually a lot of people with high school degrees, GED equivalents, and less. You can see that blue trend line, again, was where a lot of the job losses occurred in March. So first-time homebuyers, as we're kind of thinking about that maybe that entry-level segment, let's think about first-time homebuyers, because I know a lot of folks who buy homes under $300,000 are first-time buyers. Not all, but a lot are. So first-time homebuyers, 42%, 40% of overall buyers. When the whole market went on sale after the foreclosure and housing crisis of 08 into 09, actually 50% of overall buyers were first-time buyers. Now, just a word, I should have mentioned this up front. This is from NAR and this is national. So this is not Twin Cities, this is not Minnesota, this is not the Midwest, this is national. So as prices have risen since 2011, 2012, we've of course seen that share of first-time buyers shrink a little bit. So down to 33% compared to an average of maybe, 38, 36 or 38, maybe 40%. So as they're losing some of their share, those first-time buyers, let's look at the median age. In the 80s, you could be 29 years old. That went up to 30, and then it's gone up to 32, down a little bit when prices were low in 08, 09, and 2010. Actually, 30-year-olds, or I should say 30 was the median age of first-time buyers. And then again, we can see pretty clearly as prices have risen, buyers have to save for one more year. So they have to wait till they're 31 years old. And then as prices continue to rise, you got to wait one more year for savings for a down payment until you're 32 years old. And then actually last year, the median age of that first-time buyer is 33 years old, the highest on record in, 40 years roughly? Which kind of makes sense because I suppose prices are at an all-time high, but rates are one of the sort of saving graces that's offsetting some of those declines in affordability that are coming from these pretty strong price gains. So I've just kind of plotted these together for you guys. Maybe this one's a more useful way to look at this and visualize this. So again, as buyers make up a smaller share of the overall buyer pool, they're of course having to wait a little bit longer. So we can sort of see a little bit of an inverse relationship here. Interesting stuff. All right, let's keep the mood a little bit light. So these first-time buyers are millennials. Are they not really feeling it this time? Well, here they are, living through their second once-in-a-generation or maybe even once-in-a-lifetime economic collapse, or what should be a once-in-a-generation or once-in-a-lifetime collapse. And they're just not really feeling it. So they're elbow bumping and forcing a smile through it nonetheless. So millennials have finally stopped going out for avocado toast because they can't anymore, not because they elected to stop. So can everybody suddenly afford a house? Kind of an interesting approach there. So all this gives us a theory. If the top and bottom could be weakening because of reasons we just discussed, might the middle perform the best? So again, these middle market segments sort of leads us to believe that maybe those middle market segments will perform the best. Let's take a look. So I'm going to go a little bit back historically. This is about a month ago, maybe a month and a quarter ago, roughly. And so this is end of March compared to the week prior, and we can see that the change in showing activity. We can see fairly notable declines in maybe some of our entry-level segments. By far, the most dramatic declines came in that luxury, those luxury segments, say 800 up to maybe 1.4, 1.5 million. So much of the activity over a million is sort of 1.1, 1.2, 1.3. Pretty limited as you get above 2 or 3 or 4 million, although we do have some. So overall, down about 22%. We can kind of see what's happening, a little bit of a dynamic here. It does appear this mid-market range is down the least. Let's fast forward a week here. So this is sort of second week versus first week of April. Kind of all over the place. There's not really a clear trend here. Looks like we had a little bit of a snapback again with million plus, because it was down pretty dramatically. So it's not a surprise some of that came back. And remember, I'll say again, because this will happen throughout the day here. Let's say showings in million plus went from, I don't know, 50 to 75. Well, that's a 50% increase from only 25 additional showings. So pretty small sample size in some of those sort of luxury segments. And I know that can drive fairly dramatic change. So again, pretty clear here. Everything was down, different paces depending on the price point. Fast forward 1 week, some up, some down, some up, some down, 2 up, 1 down, 2 up. Fast forward now to 419 versus 412. Pretty different image here, where we see every single price point showing gains in showing activity. So there was 93% more showings in this 800 up to a million range than there were the prior week. So again, that could be from, say that goes from 100 up to 200. Well, that's 100% growth. Still some pretty decent numbers here in these mid-market and even some of our more affordable ranges. Let's fast forward 1 more week. Now we see, right? So these were way up. And then once that kind of early recovery happened, now we have more, what you'd think of as maybe more normal growth. So, up 2% or 9 or 10, or even some 12 or 15. Again, here's million plus doing some wonky things, up about 42%. But remember, the whole market was up 5%. Also remember, I think this is going to drag down this figure because our median is still about 290 to 300. So a decline here can sometimes drag down the overall market. I think we still see this middle market dynamic going on here, where some of the biggest gains outside of this luxury segment kind of happened in these mid-market, 3 to 5 or 3 to 5 or so in those ranges. So fast forward 1 more week, 5.3 compared to 426. So this is our most recent one. Still seeing, well, I should say, we're actually seeing the strongest growth here in one of these mid-market ranges. So say a 350, 325, or 375 home saw a 33%, so a 1/3 increase. So say from 3,000 showings maybe up to 4,000 or something like that. 1,500 showings up to 2,000 or so. Pretty normal gains across the rest of the market, 6 to 8% or so. So pretty normal activity there. So here, the most recent week, pretty interesting. We actually saw that 10% pullback in showings in our most elite luxury segment, over $1 million. So I showed this last time, but I just get such a kick out of it. I had to show you guys again. I also know there's some new folks out there in webinar land today. So this is really why we love data. This is why we do what we're doing here. Let's just walk through this one more time. Early on, everything down. Next week, some up, some down, some up, some down. Week after that, everything up. Notice this is almost a mirror image. So these luxury segments that were down the most, some of them have sort of rocketed ahead or surged ahead by some of the strongest year over year, or I should say week to week gains. So again, everything down, sort of a mix, everything up, and now most things up, but obviously not quite as dramatic as this, sort of more sustainable, more normal gains here. So I just think this is so fascinating and so educational and instructive to see some of the changes by price point, by week. Really paints a clear picture of what's happened. So just an anecdote on showings before we pivot to some other topics. We have been hearing from some of our builder friends and industry partners that showing traffic is down. There's no doubt there, although some of that's changing as we saw, but it seems to be a higher quality buyer and just higher quality foot traffic and more motivated buyers. So the true qualified buyers seem to be sticking around, at least most of them, but some of the fringe buyers or the looky loons have sort of moved on. All right, how about overall showing activity by price range? So this is 4/12 compared to April 5th, those weeks. A little bit of a gain, a little bit of a decline, a little bit of a gain, a little bit of a decline. Fast forward, now we're comparing 4/19 to 4/12. Again, a very different picture. So it was sort of that mid-April period where we saw this turnaround. I'm not comfortable, we're not comfortable saying that we're out of the woods yet, or even that the worst is behind us, but it's possible. And we are definitely seeing some gains and some growth after we saw, obviously, a pretty sharp pullback early on. So again, some gains, some declines, some gains for this week, pretty substantial gains across the board. Pretty big one in our affordable segment there, under 2. Again, a pretty big gain in also an affordable segment, a pretty popular first-time buyer segment, that 250 up to 300 range. Maybe call this your move-up market, 350 up to 450. Say some of the new construction in Lakeville or Blaine or Woodbury or Minnetrista or something like that. You see a lot of that kind of price, say 350 up to 425 or so. 426 compared to 419, again, a little bit up, decent gain, a little bit of a decline, mostly gains across the rest of the price points. And then again, our most recent number comparing the week ended May 3rd versus the week ending April 26th. Across the board gains, with the exception of our friends in the luxury segment in million plus. Again, where are the strongest gains? I think we got to talk again about our middle market theory. Most of these, some of the strongest gains, the strongest growth here, once again, was in that 250, roughly 250 up to 400 ranges. Again, let's do our little trick where we break this into quadrants and kind of look at things. So the week ended 4/12, a little bit of a mixed bag here. How about the week ended 4/19? This is when we really saw those gains. Week ended 4/26. Some gains not quite as notable as up here. And then our most recent data through May 3rd. Again, showing gains pretty much across the board, but the strongest by far in those sort of mid-market ranges. That shouldn't be a surprise, guys. That's kind of our bread and butter. Okay, so thinking about the share this time, not just the number or the gains, let's think about the share. So again, we're going back a little bit into history. You can see growth here under 200, a little bit of contraction here between 2 and 250. I had to bring these out to the hundredths place just to kind of show some details on exactly what's happening. Fast forward one more week, a little bit of a change. About 1 in 5 showings were for homes priced between $250,000 and $300,000. Here's 426 compared to 419. So here, 1 in 4 showings was actually under 200,000. About 1 in 5 showings was between 2 and 250, and 1 in 100 showings were above $1 million. Here we are. We've arrived at our most recent data. Pretty fascinating stuff. See a little bit of contraction here in our most affordable segment, a little bit of contraction here in that little step up. That step up maybe first time buyer or affordable segment. Where do we see the growth though? Again, 250 to 300, pretty notable growth here, 300 up to 400. A little bit of a gain here, a decline here, and a decline again in million plus. Here we go again. Middle market theory seems to be outperforming most of the other segments. And again, our median price is kind of in that range. So half or above and half or below that roughly $300,000 mark. So this makes sense. I know we've already been talking about it a little bit, but let me just say a word about this notion of a life cycle of a listing. First, it's new, then it's active, then you have showings on it. Eventually, hopefully, it goes under contract. And then finally, it hits the closing table and becomes a closed sale. We're always trying to get a little bit earlier in this process to help us with forecasting a little bit, lowercase f forecasting. Forecasting is very challenging in this kind of environment. But just so we can get a little bit of an early glimpse and a leading indicator on what might be happening with showings, so we can see what might be happening with pendings, so we can see what might be happening with closings. So yesterday's new listing is tomorrow's active, and then Saturday's showing, Sunday's contract, and then Monday's closing. Of course, nothing goes that fast, but you guys get the idea. So I'm gonna take some info and some visuals here from just our regular monthly report. You guys can find this in the market report section of our website, mplsrealtor.com. Here we see new listings again by week. We're looking at the current year, 2020 in blue, compared to the prior year, 2019, in the gray dashed line. Pretty clear evidence of stabilization here. And it was even nice to see a little bit of an uptick. So, I'm feeling pretty optimistic about this, although again, I just can't say that we're out of the woods and that the worst is behind us, but it is really nice and really encouraging to see some growth here. Still a gap between this year and last year, which is to be expected, but depending on what happens with the timing of all this and vaccines and if we can get some of that pent up demand out into the marketplace, and again, people feeling a little bit more confident to go out, list their homes and write offers on homes. So new listings, a little bit of an uptick. We saw that decline that started early March, and we're finally seeing a little bit of an uptick. So do watch this report, or just join us on our weekly webinars, and you can check it out there. Pending sales. So on the buyer side of our equation, we see this year in blue, declining mid-March. Again, we're seeing a little bit of an uptick. Some really encouraging signs here. We talked a little bit about maybe this or this being an inflection point that signals, a trend reversal, as some folks call them. So 2019 still a decent, still a pretty good amount lower than last year on the signed contract side, but again, really nice to see this growth. Inventory or active listings or homes for sale, however people think about this, still a gap. We're still on the decline on this one, but that could change depending if sellers are able to get some listings on the market, assuming buyers don't gobble them up right away and write offers and having 6 offers after being on the market for 4 hours. We'll kind of see what happens with that. Okay, change in new listings week to week. So I know we did a lot, we talked a lot about showings at first, and I want to talk about new listings now by price point week to week. I was kind of surprised to see some declines here in our affordable segments and increases here, but that's what happened, and that's 426 versus 419. How about our most recent data from May 3rd compared to almost that final week of April? 50% growth in 3/4 of a mil up to a mil, about a quarter growth over $1 million. Overall, we're up 5%. Remember why so much of our volume is in this segment. So sort of whatever this segment does, it has a lot of weight or a lot of gravity, so it can kind of pull the overall picture up or down. This is not a big change. I call anything within plus or minus 1%. I kind of call that flat movement, so not a ton of change here. I'd say that's a sign of stability. I would like to see growth in new listings, but sometimes it's month timing. I know a lot of sellers come online at the beginning of the month, so maybe we'll see some increases here next week. You guys will have to tune in to find out. Pending sales, again, shifting gears to the contract side, to the buyer side or the demand side. Here we have a pretty wacky, pretty wonky increase in million plus. Here we do see a gain on the buyer side in that 350 up to $500,000 range. Maybe a little bit of a surprise to see that down 6% in that bread and butter range. When you think about pending sales, you guys, these segments are already so pressured from lack of supply that maybe it's not a surprise we saw a decrease on pendings. Most recently, 5.3. You guys can kind of see what happened there. Here's our down 0.3% because of the weight of this segment. Here's one of my favorites. I hope you guys like this too. This shows new listings. This is daily new listings, but we've sort of rolled them into a moving weekly average. So here we've got 2020 current year in black and the previous 3 years in varying shades of blue. So 2020 was looking pretty good, pretty strong. New listings actually above the previous 3 years for a decent chunk of time there, and pretty well matched up with 2017, which was a decently strong year for new listings, at least in the first quarter. Again, we'll see how this plays out moving forward. As some of our weekly reports and other data have confirmed, we once again have a confirmation or a reaffirmation of stabilization here, followed by a little bit of growth, and now we've seen a little bit of stabilization again. Obviously, we would like to see growth here. We will have to wait and see what happens, but I still think this is a pretty encouraging sign. On the pending side, it's actually an even more encouraging sign. Oops, forgot about that. So what's happening here? On the pending side, we've seen that stabilization in, say, mid-April, and then we really have seen growth since then. The seller side is a little bit less clear, although I think there's good evidence of growth. On the pending side, I think there's even stronger evidence of growth. So again, a little bit of an uptrend. Could it last? So let's just recap some March numbers before we transition into April. I would like to remind us again that the first half of March was nothing like the second half of March. And also recall that we're comparing to a fairly snowy and fairly wet spring of 2019. So here's how March looked. Again, middle market segment seemed to be up the most on the seller side, so new listing side of things. 33% gain in 250 to 350K, pretty strong number there. Again, a decline here. So much of this product has been snapped up. Maybe investors, maybe some flippers, although I know there's less of them as prices have risen and there's less opportunities for that. But these are tough segments just because they're so thin. On the pending side for March, again, we see that same growth in most of our middle market ranges. Pretty decent growth in that maybe second move up market or third move up market, or maybe the early luxury segment or the maybe the entry level luxury segment. Decent gain there, a quarter, up about a quarter, compared to 30% in that 350 to 500 range. We had a little bit of a normal distribution there, didn't we? But don't get spooked. It's not a paranormal distribution. Okay, my friends, a little bit of a warning here. Viewer discretion is advised. We're gonna transition into some April numbers, which obviously are going to be uglier than March numbers. So just a warning there. Yes, April. So before we even dive in, you guys, I want to mention something. These are preliminary numbers. They're a pretty good indication of what's to come and what's happened, but remember, these are not our official numbers. Our official numbers are in our monthly indicators report that goes live in, I think, about a week and a half from now. And we sort of time that with our official monthly press release. So those are our official numbers. Typically, we don't see a ton of change, but just remember, on those official reports, we do allow some extra time for status changes to trickle in. So it's just a little bit of a better picture. Okay, once again, let's take a look at what's happening here. We see our biggest declines, well, not quite our biggest. I guess our biggest decline was technically in our million plus range again. No surprise there. Second biggest decline seemed to be in our affordable ranges. So basically under 200,000, effectively anything under 200,000 saw pretty strong declines, 40 to 45% declines in new listings. So sellers really pulled back here in the entry level and here in the luxury segments. Here again, we have a little bit of this inverted normal distribution there. So I will ask us again, do we have a little bit of our theory being proven here? Our mid-market ranges seem to be performing the best. Excuse me, they're performing the least bad. Moving over to the pending side of things, so the demand side of the equation, we again see a pretty significant pullback, about maybe a third up to roughly 40% in our, kind of truly affordable segments under 200,000. I was a little bit surprised that this $500,000 up to $750,000 segment had a stronger decline than $750,000 up to $1 million, and even $1 million only saw about a 16-17% pullback. Again, I still think we see a pattern here. I'll call it out one more time. Our mid-market ranges seem to be performing the best for reasons we discussed up front. Here again is our official March numbers. I won't spend a ton of time here. We're going to be updating this with April numbers, and we'll be posting our reports in about a week and a half. So actually for March, seller activity up 16%. That's a pretty strong gain, and it's exactly what we wanted to see. Well, at least in the first half of March, because we're so undersupplied, inventory is so low, and buyers are pretty committed, pretty motivated, given rates. At least in March, mostly the first half of March they were. But again, we're seeing some signs of turnaround. So it's really good to see some growth here, which might lead us to believe when we get out of this, we might see some additional supply coming on. I don't know, what else is important here? 99.2% of original list price. So not current list price after a price reduction, but actually original list price. See a pullback in the number of active listings, and also saw a decline in our absorption rate, or month supply of inventory. 1.7 months of supply, guys. This is a pretty tight market still, very much undersupplied. We're actually shooting for 5 to 6 months. That's what most scholars and NAR and others kind of call a balanced market. So we're looking for 5 to 6, even 4 to 7 is pretty balanced. And you guys can see we're really nowhere near there. I guess I forgot to call out prices. Like I mentioned, we're about 290 to 300. We ended March at 297,000. That was up 8% from 2 3/4. Okay, so here's where things are going to get a little bit different. I'm kind of excited to share some of this with you guys. So North Star page. Once you guys are logged in, I'm hoping most of you are familiar with this. I'm betting that you are. If you're not, you'll see the InfoSparks link right here under the Home tab. You will also see an InfoSparks link here under External Links. And let me just show you guys the one last place on the actual listing page. So I don't know, let's pick on Eden Prairie today. Hey, it actually has a photo. That's impressive. You guys will see right here, this InfoSparks link. And please notice, since we're in Eden Prairie, when I click on the InfoSparks link from there, it takes us to Eden Prairie. So a little bit of intelligence baked into the tool. So let's close that and let's get back to the main tool. Oh, you know what, guys? Let me refresh this for us, just so you guys can see where we land. So by default, we're looking at the Twin Cities region. We are looking at the median sales price, 285, but that's over the last 12 months. So let's switch just to April. So actually April, for the first time ever, we surpassed the 300,000 mark. You guys can kind of see that mark right here, and we have surpassed it. We're only looking at 3 years. I, of course, like to take it to the max and kind of look at the all the history. So here we are, 305,000. You guys can see, even in the peak of the bubble here, we really weren't at 300,000. We weren't even at 250. So this definitely marks sort of a watershed moment for us, I guess. it definitely happened at a pretty interesting time given everything else going on. So prices rose 9% in April. So we have not seen a price decline, even though, let me pivot to new listings here. You guys can really see, even in our monthly trend line, which is a pretty volatile, pretty noisy trend line, just because, of course, we don't see a ton of new listings in December and January, and we do see a ton of new listings as we get into spring market. So April, May, June, and into the summer months is kind of when we peak. We can really see after being sort of at this level, sorry guys, I didn't mean the labels to jump all over. Once we've, you can really see those levels right above maybe 8,000, and we can really tell something is different here. Something has changed. So you can see the change over here. I'm even gonna show the bar chart. We can see this nearly 25% decline, 5% growth in new listings, April of last year compared to April of 18. So that's new listings. Let's again show pendings. Here we see this 20% decline. So not quite as much of a decline as on the seller side. So I guess that tells us buyers were feeling a little bit better. Maybe I should say a little bit less bad than sellers. But again, we are seeing some signs of recovery there, which is great. Closed sales is a different animal. We actually saw a 2% increase in closings, but let's remember, closings in April were for signed contracts in maybe January, but mostly February or maybe the first half of March. So just be aware and be cautious about that. Days on market still faster, 20% faster. Maybe this is due to what we talked about with a lot of the sort of casual, non-committed buyers, or maybe I should say home shoppers, have kind of dropped out. So it's a much more motivated buyer. So maybe that partially explains this. We've been looking at the market as a whole. I also want to look at some of our segments or some of our subparts. So let's just start with price ranges. These price ranges are fine if they work for you. Let me click on custom, and I've already got my custom. Oops, I guess it erased them. Sorry, guys. So Twin Cities region, let me clear these out. And let's just go, 0 up to 249. Let's maybe go 250, 100. Let's go 500 up to a million. And then let's do our million plus market. Okay, so you'll notice now we've got those custom ranges in. I'm going to now do a breakout. So instead of filtering down to any of these segments like I'm doing here and here, let me go back to all. I actually want to break these different price points out. So I'm going to click on our breakout button. Let me just remove all because we already looked at the whole market. So days on market, really an interesting data point here, from 200 days down to 50 on the million plus side of things. Again, this is a pretty volatile segment with a pretty limited volume. So that's days on market. I don't think that's the most interesting indicator. Let's look at buyer and seller activity, as that's kind of the major factors or dynamics that affect our market. So down about 32% for a $250,000 and under, down about 17% for a $250,000 up to $500,000, down 27.5% for $500,000 up to $1 million, and then down almost 50% if you're over $1 million. So again, this is actually a perfect example, guys. We went from 200 to about 100, and that's our 50% decline. So that's new listings. Let's again pivot a little bit to pending sales. So again, on the demand side of things, 250K and under, down about 30% in terms of signed contracts. 250 up to 500K, down only 13%, so less than half the decline. 500K up to $1 million, down about 23%, and then $1 million down about 14 or 15%. Let's again just look at closed sales really briefly. A decline here. This is a pretty tough segment. And let's even look at inventory, guys. Look at some of the declines that we're seeing in that segment. So it's pretty hard to write offers if you have a shrinking pool of homes or listings to write offers on. So no surprise there. Here again is our middle market that seems to be performing the least bad, down only 13% on the pending side. A lot of your 325, 350K homes, 400K homes are in this segment. Pretty popular segment there. Yeah, we looked at closed. We kind of looked at days on market. Let's just do a quick check on absorption rates or month supply. 1 month of supply for homes under $250,000. A very, very tight market there. Next bracket up, almost 2 months of supply, little bit better. 500 up to $1 million, almost 4 months of supply. And then over $1 million, we actually have 9.5 months of supply. So definitely an oversupplied market, although as we can see, that luxury segment has gotten better. So let's look at some other ways to break out the data. Let me go back to all price ranges and let me just quickly do property type. So again, I'm going to take off all. I'm also going to take off our townhouse condo segment so you guys can see how I take that off here so I can add it back in or take it off. I'm kind of trying to weave in a little bit of a demo here so you guys can utilize this as well. Oops, sorry guys, we're still in month supply. Let's look at new listings by property type. So single family down about 23%. Condos by far the biggest pullback at about 40% on the seller's side. And then townhomes down only about 21%. So actually the townhome segment performed the best here. Let's look at pending sales. Single family down about 15%, condos down about 50%, and then townhomes down about 31%. So that's property type. Let's again go back to all. Let's just take a peek at new construction versus existing. So I just did our breakout. I'm going to again remove all. Let me just maximize this so we can see what's going on. New construction, only about a 3.5% decline. Remember, we're still in pendings here, so I'll switch to new listings in a moment. New construction, pending sales down about 3.5%. So there were 3.5% fewer purchase agreements signed on newly built homes. But there was 21.5% fewer contracts signed on previously owned or existing homes. You guys can see existing is obviously our bread and butter. It's about 4,000 contracts out of what, about 45 or 4,600. So by far the bulk of our market, maybe 85% or so. As promised, let's switch to new listings. So sellers of new construction, so builders, actually listed 13% more homes on the market in April of this year compared to April of last year. I think weather this year had a lot to do with it, especially when we think about the weather last year. Maybe permitting is going a little bit better. And then you can see previously owned, there's our pullback of a little over 28%. So let's keep going, and then we'll take some questions before we wrap up. I'm gonna skip some of the foreclosure stuff only because it's just not a big segment of our market. We'll keep an eye on it. I'm not convinced we'll see a surge in lender mediated activity, but we're watching that. Depending on what happens with forbearances and how fast things kind of get back to normal. Maybe let's do a quick square footage. New listings. Yeah, down kind of evenly across the board, whether you're talking about bigger product over 2,500 or maybe smaller product and some condos in here as well, under 1,500 square feet. Let's do a quick bedroom breakout. New listings. Down about 20% for 3-bedroom homes, down about 40% for 1-bed homes. Again, a lot of condos here, and we already saw a pretty strong pullback on the condo side of things. 4-bedroom homes down about 1/4 in terms of new listings. How about pendings? Yeah, pretty similar for 3-bedroom or 4+ bed homes, down about 17-18%. 2-bedroom homes down about 28%, and actually 42-43% decline. Again, a lot of condos in that 1-bed segment. I don't know that it's worth doing waterfront, but I suppose as long as we're here, let's just take a quick look. The vast majority of our market is, of course, non-waterfront, where we saw a 20% decline in pending sales, so signed purchase agreements. We actually saw a 1% increase in waterfront. Wow, one new contract, one additional contract signed from 105 to 106 for a roughly 1% increase there. And you guys can see what happened with water access versus just river. So that's pendings. Let's just take a quick look at new listings. Yeah, not that much to see here. 20% for private waterfront, almost 40% for river access. So think Highland, Mac Groveland, think Longfellow, Howe, Cooper, Seward neighborhoods. You do have riverfront there. Down about a quarter if you have water access, and also down about a quarter for our non-waterfront segment. So I know we're getting toward 3 o'clock. It's probably a good time to pause and maybe take some questions. I think I have just a few more slides. So before we do that, I just want to talk about, I'm even gonna shift gears a little bit here, and I'm gonna play a mind reader. I know what you guys are wondering about, the big question: how will this impact home prices? We already saw how March and well, early April is kind of looking. You know, the short answer is we don't know how this will play out and evolve moving forward, and truly nobody does. The long answer is, of course, it depends on those three factors that we discussed. I want to call something out from Chief Economist Dr. Lawrence Yun. He's the economist at NAR, someone I follow very closely. He's even starting to recognize me because I go up to him and ask him so many questions at conferences. So he says that, you know, we should expect more temporary interruptions to home sales, right? That should be expected in the coming months. However, home prices are still likely to remain firm and even rise. So that's according to Dr. Yun. You know, let's just wrap up with a few takeaways here. I know this is a lot of text. I just wanted to kind of centralize all of these thoughts for you guys and for posterity in the recording. So unprecedented situation and uncertainty abound. We saw that sharp pullback early, followed by, you know, what I'd say is a pretty decent, maybe even a fairly impressive recovery for now. March looked good, but again, first half versus second half. We already saw 2020 was off to a pretty strong start, you know, with both buyer activity and seller activity. April numbers, however, are showing across the board declines, as we saw by price point for both new listings and pending sales. Of course, this goes without saying, but I'll say it anyway. All price points, property types, and local markets, whether neighborhoods, zip codes, cities, school districts, are unique. And we mostly use metro-wide data just because we're kind of, we have the macro view here. Pretty challenging to talk about all 300 plus different cities in the metro. So where we go from here really depends on so many factors, many of which we discussed. Depending on how this plays out, it is possible that motivated sellers choose to drop price in order to chase buyers and attract buyers and incentivize more buyers. And it is possible that they become comps for their neighbors. Not saying it's going to happen, neither is Dr. Yun, but it's a possibility. I think this is so key. We're still so undersupplied, especially say under 250 or under 300,000, that I just don't think we're likely to see price declines. Yeah, I should give a caveat. If we do see price declines, I would expect those to be in the higher price points, in the more luxury segments. Say over 750, over 800, or especially over $1 million. We already saw that was a pretty, well, not extremely oversupplied, but with 9 to 10 months of supply, that is an oversupplied market. So depending on how we see buyer activity and seller activity play out, you know, that's a good segment to watch. Again, back to our supply discussion, inventory could triple and we'd still be in a seller's market. So I think that's a pretty compelling data point. Even if we saw a lot of sellers list their homes, you know, for any number of reasons: financial hardship, divorce, trying to take advantage of, you know, maybe the peak of the market before things change, if things change, depending on how things change. So lots of different reasons why people sell, maybe a job in another city if you lost your job here, who knows. So even if we saw a lot of supply coming on, and even if assuming demand stays constant or even declines a little bit, we'd still be in that seller's market. I know I mentioned number 8, luxury end of the market will probably be harder hit than other segments. We're already seeing that, and I would expect that to continue. And with that, I want to say thank you for joining us today. It really means a lot to us that you'd check out some of our work and some of our reporting and our data. And I will open it up to questions or thoughts. And don't forget to wash your hands.
All right, doesn't look like we have any questions coming in at the moment.
No questions, huh?
So thank you. That was lots of great information today, David. If anybody does have questions going forward, always feel free to reach out to us, of course.
Yeah, and I should mention too, Ann, I just want to thank our sponsors again for all their support. Without them, this wouldn't be possible. So thanks again to Bell Bank Mortgage, North Star MLS, Royal Credit Union, and Supra. I also should say a recording of this webinar will be available on our COVID page on the mplsrealtor.com website. Please do join us next time. I want to extend an invite to join us next time at this time for the latest information. We'll have one more week of data. We'll also have a better picture for April numbers, again, as we've seen some of those status changes trickle in. Registration is required, as of course you guys know, and the link is on our homepage, mplsrealtor.com. And with that, I want to say have a great day, stay safe out there, and get in touch if you guys have any questions or needs or concerns or feedback. So thank you again.